Welcome and thanks for joining us on Real Investment News. We've got Thanksgiving right around the corner, and I'm with a man who thinks we are in what's called a turkey market. Is that right, Lance?
Well, that's absolutely right. You know, we have a bull market. That's when stocks are going up, and then we have a bear market when stocks are going down. So this is my annual dubbing of the turkey market.
Coining a new phrase here.
We're going to try to start this today.
All right, so we've got an article out on realinvestmentadvice.com that we want you guys to check out too, but we're going to go through this and hopefully explain it in an easy to understand and digest way.
Exactly.
I'm telling you, that's how we're going to explain this. Okay, so tell me, where did you come up with the turkey market?
Well, I was just thinking about, and it's not an original idea, by the way, and I wish I could take credit for it, but Nassim Taleb wrote a book a few years back in 2007, called The Black Swan. And the point of the book is that every market ultimately ends, and it generally ends on the back of some unexpected event, which has been dubbed the black swan. When you have a group of swans, the oddball is the black swan that you see every now and then. So it's those unexpected random events that we can't plan for, we don't know that they're going to happen, that tend to occur. And he equated this to the life of a turkey, which is absolutely correct, because we've had a market now since 2009 that's had the invisible hand of the central banks behind it. Lots of liquidity have been coming in, and it's lured investors into the sense of complacency that, well, they've been investing, the markets just go up, and it really doesn't seem to matter what happens, whether it's a geopolitical crisis or the election of Donald Trump or whatever it is. It doesn't seem to faze the markets. Whatever happens, well, the markets just keep going up. And so they've been lulled into the sense of complacency. Well, it's very similar to the life of a turkey. For 1,000 days, a turkey is taken care of by this invisible hand. It feeds him every day. It houses him at night, protects him from predators around the world.
And then its head gets chopped off.
And then,
I just wanted to throw that in there.
I know. It's that first day, the 1,001st day.
Exactly. So tell me, what does this mean for everyone? Why is this important?
Well,
and why should we care?
Well, you should care, because when it comes to your money, investing is about managing long-term returns. We want to invest so that over time our money compounds and grows. But what's often misunderstood, and this is often portrayed by a lot of the financial media, they say, well, the market's up 100% this year, so so what if you give back 50% of it in a decline? Well, the problem is that if I'm up 100% in my portfolio and I give up 50%, I'm back to where I started. So when you're looking at terms of loss, in terms of percentile can be very deceiving. If we give up a large chunk of the gains that we've made, that's years of accumulation that we've now lost. And unfortunately, like a turkey, we don't live forever. So we're going to have to deal with our life expectancy and our financial goals. So not paying attention to the risk leads to these unexpected black swan events that occur on a fairly regular basis that take away large chunks of investment capital. And so in this article, I've lined out some of the issues that are currently accumulating in the market that have always preceded black swan events in the past. Now, the black swan event itself is not what causes a crash in the market. It's what tips the balance of excessiveness in the market to a period of reversion, what we call a reversion to the mean. So when things get extremely overbought, prices have run up extremely far, valuations are very extended, people are exceedingly overconfident, there will be some event somewhere along the way, and we don't know what it is. That's why it's called a black swan. It's that random, unexpected event that changes that dynamic on a dime, very much like the hatchet in the neck.
I'm not sure I know the hatchet in the neck.
That's what happens to a turkey.
Oh, the hatchet in the neck. Oh my gosh. See, I don't have to deal with that, thankfully. I just cook it. Okay. So let's go over some of these graphs and these charts that you've created in your article so that, they're easy to understand. We've gotten past the 1,000 days in 1 day's chart, I believe, unless you want to explain that further. Okay. Let's talk about the next one, the stock market sentiment.
Right. So this is what I was saying a second ago. If we look at the financial markets currently as they exist, there are some similarities that we see at every peak turning point throughout history. And the first thing is like a turkey, investors have become extremely complacent and overconfident in the markets because, well, market prices just seem to go up. They never seem to go down. We have the longest stretch in history without a 3% correction going on right now. So if you have a 3% correction, people aren't even going to understand what that is because it's been so long since they've seen one. It's going to feel a lot worse. But you look at confidence, you look at sentiment, you look at how people are invested, whether it's extremely low volatility index in terms of complacency, extreme overvaluation in terms of people have more money invested in equities, they have the least amount of money invested in cash currently, as we've seen at previous peaks of markets. And they're extremely confident about the direction of the markets, more so than just about any other point in history. So when you have the combination of that extreme comfort, so to speak, that's when the unexpected events tend to occur.
And so what are your suggestions for people that are in a turkey market right now and are invested in it and have a lot of assets and a lot of these stocks and a lot of these things going on?
Well, yeah, and this is where portfolio management comes in and risk management. While a lot of advisors recommend just riding the markets out over time, we've done a tremendous number of studies on our own website at realinvestmentadvice.com, but this is also a lot of just common sense, is that if I have only 30 years to get to my end financial goal and I wind up repeatedly giving back 30 and 40% of my money, just simple math will tell you that you are not going to wind up at your end goal. You may make money over time by just riding markets out, but you're going to be far short of the retirement goal that you need to accumulate that dollar value that we need to retire. So when you're in a market like this, there is this sense of guilt that is derived from the media that's put upon investors that say, well, if you take money out of the market, you're going to miss out. You're going to miss out on something. Yeah, what you're eventually going to miss out on is that you may be invested right now and you go to all cash today. Now, I'm not recommending that, but if you went to all cash today, very likely in the next 18 to 24 months, you're going to be ahead of every other investor in the market because the correction will wipe out a big chunk of this game. We'll wipe out 2 or 3 years worth of advances during a normal market correction, not to even mention something that could be like a financial crisis type situation.
Right.
So rebalancing risk in the portfolio, reducing some of the exposure to equities, particularly areas that aren't performing well, adding a little bit of extra money to fixed income that can provide an income stream and provide some capital preservation. Those are all just small things that investors can do to reduce the risk in portfolios and generate some protection and inure themselves to a longer, to lock in some of the gains they've had and protect those going forward.
And that's the gist of the article too. It's kind of explaining what is happening, what's going on right now, and what is the best way to handle it and how to be involved in it.
We go back in history and we look at valuations. We look at the deviation of prices from very long-term means. And what we find very similarly is that in every single case, when you have a lot of complacency in the market, you have a very big deviation in price from long-term means. I'm talking about 6-year moving averages, very, very long-term moving averages. And you've got one of the greatest deviations that we've seen in history, 3 standard deviations above a 6-year moving average. Now, that's a lot of technical speak, but what it means is that if you take a rubber band and stretch it as far as you can, it can't stretch much further without breaking.
Right.
And you take a look at that, and you take a look at the excess valuation. We have the second highest level of valuations in history. Now, whenever it's not just one of those issues, it's when you line all 3 of them together. When they all come together, historically, those have marked more significant turning points in the market that have led to more severe capital losses. We're not talking about a 10 or 20% correction. We're talking about historically 30 and 40% corrections. And that's why each one of these charts go through. We also have relative strength at over a 3-year period at one of the highest levels in history as well. So again, just no matter how you mark this out, the market is extremely ahead of itself, combined with an extreme sense of complacency. And in all intents and purposes, this is a market 2 days before Thanksgiving.
Right, and it's definitely exciting. And I do want to direct everybody again. This article is on realinvestmentadvice.com, and we've got all of these explanations for those of you that want to watch the videos, want to hear Lance, want to hear other interviews that we have with other experts. Lance, our chief financial strategist, as well as the host of the Lance Roberts Show. We're going to have all of this on Twitter, on Facebook, on our website, realinvestmentadvice.com, as well as realinvestmentnews.com coming up here shortly. But Lance, I appreciate your time, and we'll see you here for your next topic.
Absolutely.
Right?
Yeah, we're going to talk about the next one's going to be the truth about Wall Street analysis.
Oh,
yeah.
All right, good. Looking
Shocking.
forward to it. Thanks.
Shocking, I tell you.
See you guys soon.